Welcome, everyone. How are you today? My name is Dan Passarelli, and I am going to be your host for the next hour or so. If you can hear me, make your way on into the chat box. Oh, wait, apparently now I can start my video. And give me a big old yes. There we go. Okay, great. All the technical difficulties have been fixed. Yay. Oops, except that I'm on the last slide. There we go. Okay, you guys can hear me. That's awesome. So my name's Dan Passarelli, and today we're going to talk about how to trade credit spreads. Credit spreads are one of my favorite strategies. It's definitely one of the go-to strategies when I'm looking at a particular stock or ETF, and the beard is longer than it was, but not really new. So yeah, credit spreads are one of my favorite strategies to trade when I'm looking at stocks and certain criteria are met. And I'm going to share with you what all those criteria are in just 1 minute. Before we get started, I need to point out options are not for everyone, and you should read characteristics and risks of standardized options before trading. Okay, so excuse me 1 second here. Okay, so we're talking about spreads. So let's kind of look at the mile high view for just a second here. Why would we trade a spread instead of just buying a call or something? Well, the reason we use options in general is to what a lot of professionals will call shape your risk, right? If I just buy a stock, then if it goes up, I make money. If it goes down, I lose money. And, I've sort of got this pretty binary sort of bet on, right? But when I use options, I can control my risk. I can hedge and protect my portfolio, or even a stock on an individual trade. I can lower my capital expenditure on a trade. I can trade what is called option-centric risk, meaning I can make money from time passing, or if implied volatility changes. I can even take on leverage. I can get a greater percent profit when, when the trade goes my way. And at the same time, I can also have lower dollar amount losses. Now, one of the things that we do when it comes to spreading is we use spreads in order to sell options on a less risky way. Because look, when we sell options, here's what we want to do. We're selling them because we think that in the future they'll become worth less. So we sell them at whatever price we can sell them now with the objective to buy them back for less later. And one of the ways we profit when we sell options is by collecting time decay. As time passes, options lose their value. And so when we're short them, that's one thing that's sort of on our side. The risk can be unlimited when we sell options naked. And that's a problem. Even though time decay works for the trade, if there's a big enough move against us, it can be trouble. So the solution, one of the solutions, becomes credit spreads. And there are two types of credit spreads: call credit spreads and put credit spreads. A call credit spread is when we sell a call and then we buy a higher strike call with the same expiration on the same underlying. A put credit spread is when we sell a put and then we buy a lower strike put further out of the money with the same expiration on the same underlying. So before we go any further, I feel like the best way to think about credit spreads is this. The short option is the trade. That is where you're making, the short option is the trade. That is where you're making or losing your money. The long option is just the insurance, okay? So if you think about it that way, you're going to get a lot more clear picture of what it is you're trying to accomplish. All right. So let's break both of these trades down. We'll start with the call credit spread. Why would we use a call credit spread? Well, because we want to profit from low volatility, right? Typically in a particular direction. In this case, we want to profit from the stock not rising very much. We'll talk more about that in a second. We want to profit from time passing while the stock is experiencing little volatility. And we want to do it in a limited risk sort of way. Now, when do we use this? When we're not bullish. So I'm not necessarily saying bearish. I'm saying we have a not bullish stance. Okay, maybe put those in air quotes. We can do that with video. Air quotes, a not bullish stance. Basically, we just think that the stock is not going to go up above a certain price. Technically, what we look for is we look for a stock that has resistance on the chart. Maybe it also has maybe it also has support and it's in a channel, but it's near the top of that channel, a little bit closer to resistance. Also, as far as fundamentals go, there's either maybe some mildly bearish news or no news at all, okay? Like basically, if you're watching like one of the top business shows, right? Maybe you're watching Tony on CNBC, chances are if he and his fellow pundits or whatever you want to call them if they're talking about a stock, it's probably actually not a good candidate for a call credit spread most of the time. Tony's a little bit more sophisticated, so maybe in his case it is. But you know, they're not these high flyers. They're not ones with these big things going on and big news, good or bad. They're kind of these boring old stocks. So I've got some guidelines, and if you're taking notes, you should write this down. You want to know your maximum gain and your maximum loss. And I'm going to show you how to easily calculate those things. We want a high probability trade, which most of the time these will be. We'll talk more about that on the next slide. We typically want to set these up between 1 week to expiration to 2 months to expiration. I have set them up with less time, but a lot of times it's hard to find trades with less than a week to expiration. You can sometimes. Going out more than 2 months until expiration is usually not ideal, because usually you could sell a shorter term credit spread and take in and get a higher theta, therefore make more. Instead of selling 1 3-month credit spread, you could sell 3 1-month credit spreads. We also, like I said, we're not looking for a stock that has a lot going on. If earnings is coming out, we're not going to do this. Or even if any other news is coming out. If there's a Fed meeting and we're talking about the SPY, we're probably not going to trade a credit spread on it, call or put. Now, it's common to trade credit spreads, and again, we're going to focus on the call credit spread here first, one of two ways. We could trade out of the money call credit spreads or at the money call credit spreads. So an out of the money credit spread has a higher chance of success than an at the money credit spread. It's further away, so you're going to get a lower credit received, which means a smaller payoff when the trade works out, but a bigger loss when it doesn't. An at the money spread, where we sell one call that's basically at the money and then buy one that's somewhat out of the money, has a lower chance of success than an out of the money spread. And in fact, we need not just a not bullish stance, but we would do that on stocks that were somewhat bearish on actually. We get a greater credit received, which means a bigger payoff when the trade works out. And the other side of that is we have a smaller loss when the trade doesn't work out compared to the totally out of the money spread. Okay, so let's take a look at exactly what we're talking about here. Let's say we have a stock that's trading at $59 a share. And there's resistance at $60 a share. And maybe this stock has kind of flirted with resistance. It maybe touched 60 or something, and it kind of bounced a little bit back down. It looks like it's not going to go above 60. Okay. Well, here's one thing we could do. We could sell I have NOV here on the slide, November as the example. But remember, whatever month you're watching this recording, we typically don't want to go beyond 2 months until expiration. So in this case, we would sell the November 60 call at $4, and then at the same time, buy one of the November 65 calls at $2.20. Okay. So we're selling one of these calls at $4 a share and buying the other one at $2.20 a share. So we collect $4, we pay $2.20, we're collecting a net credit of $1.80. Now that's $1.80 a share with options listed on the US exchanges anyway. Each option represents 100 shares of the underlying stock. And so in that case, that would be, I would take in literally $180. Now there's another thing of note here, and that is, you may have noticed that where I'm saying we observe resistance at $60 a share, we're selling our strike at 60. That's no coincidence. When we do call credit spreads, we get an edge by selling the strike at or above resistance and then buying a higher strike. Now, why is that an edge? Well, because look, when we trade options, we can make money by direction, let's say by the stock price movement, by time passing, and by volatility. So if $60 a share is the price that the stock has gotten up to and then bounced down below in the past, then maybe that resistance will hold. What me and my other coach, John, here have identified is that resistance tends to hold. Okay. It doesn't always hold, but more often than not, it does. So that's one extra thing that's on our side. This little, bounce. It's kind of like when you remember when you were a kid and you would go bumper bowling because, you didn't have the fine motor skills of like keeping it on the lane and out of the gutters. So they put like bumpers in the gutters. You guys, anybody ever played bumper bowling? Super fun. It's a lot easier, right? Well, if the ball gets too close to the gutter, the bumper just sort of bumps it back into the lane. That's kind of what resistance and for that matter, support are for stocks, right? Now, obviously, if you're really bad and you throw the ball really hard, it can bounce over that bumper and, stocks can go through support and resistance, but fun little analogy that just popped into my head. So a couple really important things here. I told you before that it's very important to understand your maximum profit, maximum potential profit, and your maximum potential loss. So the maximum profit, the most that can be made by trading this spread is $180 or $1.80 per share. Why is that? Let's just think about it. Well, we sell these options, we collect $1.80, and if the stock ends up staying below, in fact, here, let's go to the next slide. If the stock ends up staying below $60 a share and at expiration is still below $60 a share, all those options would expire and the $180 that I collected is mine to keep. So that's why that would be our maximum profit. Now, just looking at this graph here, what do you think the worst thing is that can happen? Well, what if the stock goes up above $65 a share and is trading there at expiration? Well, that's the worst case scenario. Why? Because the 60 call that we're short would get assigned and I would have to short stock at $60 a share. And if it's above $65 a share, I would exercise that 65 strike call and therefore buy that stock back that I sold at 60 at 65, locking in a loss of $5. But mind you, I collected $1.80 a share, so the net loss is just $3.20. That's the most I can possibly lose on this trade, unless I try really hard to screw it up. Now, our break even is $61.80, and the same logic sort of follows. If the stock is above 60 but below 65, I would get assigned on the 60 call, therefore getting short stock at $60 a share, but I P&L that $1.80 I collected. So my effective short price would be $61.80. The way to mathematically calculate the maximum loss, like, the max gain is always just what you collect. The way to calculate the max loss is just simply the difference between the two strike prices, which is easily identifiable here. It's $5, minus the premium collected. So 5 minus $1.80 is $3.20. Now let's talk about the put credit spread. This is like pretty easy, right? Like, are you getting this? Hit the chat box and give me a big old yes if you're getting this. Yes, Jerry says yes, and Herb says yes. Victor, Corey, Russ, David, Null is your first name and your last name. That's a funny name. Dylan, Siva, Michael, Tom. All right, Jim, Carlos, Eva, Ken. It's hard to read all these names going across here. Ralph. Good. You guys are awesome. So guess what? The put credit spread is just as easy. It's basically the call credit spread, but for the opposite scenario. We use it because we believe that there will be a low volatility environment, particularly maybe sort of drifting a little higher or at least not going down. And we want to profit from time decay with limited risk. So we use that with a, let's do the air quotes again, not bearish stance, okay? Not necessarily bullish, but not bearish. We have support here, or maybe we're near the bottom of a channel bouncing off support. If there's any news, it would be mildly bullish or just simply no news at all. So here we always want to know our max gain and our max loss. We want a high probability trade, which this will be if we set it up properly. We'll talk more about that in a minute too. We want 1 week to 2 months time horizon until expiration when we put the trade on. And we want no earnings or other news expected before the expiration of the options we're considering using. Murray says, do I have the rules for the credit spreads? Yes, I'm literally giving them to you right now. That's what this presentation is about. I've already done that for the call credit spread. So now we're going to talk about the put credit spread. Okay, so we can put credit spreads 2 ways as well. One where all the options are out of the money, and one where one of the option we're selling is at the money and one we're buying is out of the money. Now, I had basically the same slide here for the call credit spread. And you might look at this, like for those of you who trade call credit spreads, like there's a couple of just fun little nuances that aren't in this presentation slides that I want to share with you so that, even if you're experienced with this, you're going to get something great out of this. So over the last maybe 6 months or so, I've been looking at unusual activity. Oh, uh-oh. Hello. What the heck just happened here? Hold on a second here. Sorry about that. I don't know. I don't really even know how that happened. But we're going to fix it. Two. Give me a big old yes if you can still see my screen. Give me a big old yes if you can still see my screen. Okay, good. Okay, so what I was saying, unusual Zoom activity. Yes, Ash, yes. So this is very interesting. I've been studying unusual activity over the past 6 months, and just look, which basically means like looking at like what has traded. Okay, like hey, 1,200 of these puts, 1,200 of the April 50 puts traded at 63 cents at exactly 132 and 50 seconds and 200ths of a second or whatever it is. And I've been doing a scan that I created for credit spreads. What's very interesting is very counterintuitive to those of you who have traded these before. Okay. More credit spreads than not are at the money credit spreads, where we're selling the at the money option, and then the out of the money option is the one that we're buying. And that's pretty surprising. For many years, I've set up my credit spreads more out of the money, looking at them as high probability trades. And for those of you who look at delta as a proxy, it's really just an estimation. It's not mathematically accurate. But for those of you who use proxy as, or those of you who use delta as a proxy for probability of success, like the further out of the money you go, the greater your chances of success. So I always looked at it like that, just a super high probability trade. But I would say most of the credit spreads that I see trading, they're selling the at the money option. It's a little bit more of a directional trade. So that's why, like, I actually had this slide in the presentation. I've given this presentation a good handful of times in the past. I've had this slide in there for years, but I only recently came to the realization that a lot of people, maybe more people, do bullet point 2 here, the at the money spread. Interesting, isn't it? I was surprised by that when I started seeing that. So anyway, with put credit spreads, it's sort of the same thing here. If we sell 2 out of the money options, we have a higher chance of success because if the stock goes up, I make money. If it stays where it is, I make money. If it goes down a little bit all the way to the strike price, but not through it, I still make money. Now, they're further out of the money options, so I receive a lower credit, which means a smaller payoff when the trade works out. And as you saw how to calculate the maximum loss, it's the same with puts, the difference between the strike price minus the credit received. So that means if I receive a smaller credit, my maximum loss is bigger. So in a lot of ways, the out of the money trade, like I could pose the question here, and it would be pretty interesting to get some answers, is which of these is more risky? And it depends how you think about risk, right? The out of the money one has a greater chance of success. You'll like, if you run permutations or if you trade spreads like that 1,000 times, you mathematically should make money on a lot more of them than you lose. Whereas the at the money is more risky in that regard because it's a lot more 50-50. But if you look at it from a risk reward standpoint, even though the out of the money spread is a higher chance of success, your profit is much smaller and your loss is much bigger. So they're almost like different types of trades altogether, out of the money credit spreads and at the money credit spreads. I do like to hold all questions until the end so that I don't get distracted. But and so I'm going to do that. Wayne, hold that question and fire it back at me later. All you guys, okay? I don't like for me to get distracted because that could be annoying to you. But I did leave plenty of time for Q&A, so we're going to get to all your questions. That's my favorite part. Yours too, I hope. So here's an example. Let's say I'm mildly bullish on a $66 stock, right? Or maybe I'm not bullish at all, but there's just really strong support at $65 a share, okay? The past 5 times it hit 65, it's bounced higher. Now, another thing here, support or resistance for that matter, they're not just like these magic lines on a chart that, oh, look, the stock bounced off it. Okay, whoop-de-doo, big deal. Like they actually mean something. Technical analysis in general is a map of human behavior. It's what happened. It's a map of the orders, right? If a stock, every time it gets down to 65, it bounces higher. Why does it bounce higher? Why would a stock go up? In fact, there's only one answer to this. When we're on the trading floor and we talk about this, like I felt like I was being a smart aleck every time I said this, but why would a stock go up? What is the only reason why a stock goes up? Who can tell me? We've got a good number of folks in the room here. Somebody's going to fire off that answer right now in the chat box. More demand than supply. Bingo. Good job, Edmund. It's demand pressure. It's buyers, says Jim, too. Right, exactly. Mike, well, volume, but specifically buying volume, right? Demand, exactly. Because like if there's, 300 shares offered at $61 and somebody buys 300 shares, they're not offered at $61 anymore. The offer's higher and the bid ends up being higher too. It's just the mechanics of the market. And yeah, so Doval says technical analysis is astrology for traders. And a lot of people feel that way. And to be fair, maybe some of it is, especially for some traders who maybe look at all these like really kooky things. But like this stuff, like the basics of technical analysis is not astrology. And that's what I'm trying to say here. Like there are many like value traders, right? And I'm not saying like a regular retail trader, like many of the folks who might be attending this webinar. I'm saying like a big institutional trader with like hundreds of millions or $1 billion like in the fund, right? Who hires these quants for $1 million a year to run these models to tell him or her what the value of that stock is. Right? There's lots of people like this. And when that stock goes too far down below value, right? That's when they buy it. And they just set a target or an alert or whatever it is on their computers. And they say, oh, it went to 65. That's, 20% below our value range. That's our, brilliant genius quants told us, that is where we should buy because it's extremely cheap at that level. Like that's what a support line is. It's really not something magic or like, self-fulfilling prophecy or like, like Dole said, astrology, like there's a lot of technical things that really mean something, and support and resistance, like they're the kings of it. Like that's extremely useful information. So how do we as not quants, how do we, as not billion-dollar institutional traders, how do we use that information? It's almost like we can make the quant or the institutional trader work for us. Because we know that if there's enough buying volume, somebody added volume to that, and I like that. If there's enough demand pressure, buying volume at this price, because there's obviously, in hindsight, there's obviously people willing to put big money behind buying it there, maybe they'll be running that same model this week, right? They probably will. And so that puts this extra thing on our side. It's almost like we're glimpsing just a little bit, like a little peek through the blinds of this quant's office, kind of, right? We're getting just a little bit of this information like, this is one thing that's working for me on my side to put me ahead of statistics. And selling volume, that's the resistance line, Ken. Yeah. Yeah. Okay, so here we sell the November 65 put, which happens to coincide with where I'm saying support is in this case. We could sell it at support. We can sell the strike price at support or below support. And then we buy a lower strike put. Which one is the trade and which one is insurance? 65 put, because that's the one we're selling, is the trade. 60 put is the insurance. The maximum gain here is $1.60. The maximum loss, the difference between the two strike prices minus the premium received. So 5 minus $1.60 is $3.40. And the break even here is just simply 65 minus $1.60. So that's $63.40. Now I want to point out yet another thing here that's not even on the slide. Just another thing. I mean, is that okay with you guys if I share like a couple of little nuggets that are not even supposed to be in the presentation, but like I share a little extra? Is that okay? Give me a yes if that's okay. How did I know you were going to say that? It's almost surprising. Okay. All right. So this is something that I think is pretty interesting here, right? I have had people say, well, why would I sell a put credit spread where I can only make $1.60 when I could just sell the 65 put and I could make 270? It's like almost twice as much, maybe 80% more, whatever that math comes out to. I'm limiting my profits if I sell a spread instead of just the outright put. You ever hear somebody say that? You ever think that to yourself? And sometimes it feels that way too. But here's the thing. What if I sold 2 of these spreads? I could make 230. I could make more than just selling the put. And there we go. Murrah hits it right on the head. Great job. And a couple other people chimed in the same thing. Recipe for disaster. Exactly. We have unlimited risk with the put, right? So we have protection. And if we sell 2 of the spreads instead of 1 put, we can actually make more and potentially lose less. Now, that's not 100% universally true because, if we look at this, if the stock ended up right at 60, if we sold 2, we could lose 640, right? Whereas just by selling the put, we would lose a little bit less at this point. But, down at 55, at 50, at 45, we've got so much protection with this. And that's why, like before, when I was saying about like, we want low volatility, here's another thing. The most we can make is $1.60. I called this a not bearish trade as opposed to a bullish trade, right? It does have a positive delta. We can talk more about the Greeks later. I saw somebody ask a question about the Greeks. I want to get to all of them. I might ask you to ask them again, but just hold off. I believe the next slide is actually our Q&A. So just sit tight for 1 second. So this is interesting. The most here we can make is $1.60. We've a positive delta. Is this a bullish trade? I mean, we look here, the higher the stock goes, we have a profit. But if the stock goes to 65, we make $1.60. If it goes to 70, we still only make $1.60. If it goes to 100, we still only make $1.60. So what this is really more for is it's for low volatility. If we think that this stock is going to explode up, this is a terrible trade. We'd much rather buy a call. If we think that the stock, is going to fall a lot, this is a terrible trade too. It's better than just selling a put, but it's not good. So what did we just learn from that statement? The credit spreads in general, call or put, are good for low volatility environments. When we think the stock's not going to go up too much and we think it's not going to go down too much. Basically between the break even, the stock is starting at 66. We want it to stay above the break even, but if it goes up a lot, that doesn't really help us. We want it to be somewhere within this sweet spot right here. If we thought it was going to go up a lot, we'd buy a call, and that would just, that would be a whole different conversation. Ooh, I like dropping these little nuggets in there, so that you guys can leave this presentation and just put the stuff to use and really be able to solidify and think about these things more clearly. I love it. I love it. I love it. Now you may ask, by the way, maybe somebody did. I was now looking at the questions. Dan, that's me. Do you ever sell puts? Not part of spreads. And that answer is yes. I sell cash secured puts. I don't sell naked puts. I sell cash secured puts, and I only sell them in my IRA. I've got a couple on in there now. In fact, I've got I believe it's in 2 different stocks in my IRA. I sold some cash secured puts, and you know what happened? The stocks had fallen below the strike price. Yeah. Now that's usually when most traders panic. That's usually when most traders say, well, before traders do that, they say, yeah, I would be okay getting assigned. And then it falls below the strike price and they're going to get assigned. And they say, oh no, this is terrible. I'm going to get assigned. I'm going to lose money. But what I said before I put the trade on is not I'd be okay if I get assigned. I said, I hope I get assigned. That's actually why I do cash secured puts, because I want to get assigned. And if the stock goes up and I skate and I get to keep the premium, that's okay too. But when it falls, enough where I get assigned and I get to keep that premium, it's like I can buy the stock. It's like I was already thinking about buying the stock, but I get to buy it at a lower price, not just because the stock went down, but because I also get to keep that premium. So this is a very, credit spreads are a very specific way. You trade them when you have a very specific thesis on your trade. Low volatility. I don't want to get assigned on anything. I just believe it's going to stay above the strike price and I want to keep the premium. Okay, now it's time for some questions, which is my favorite part. And I'm going to work like kind of from now. So if I don't ask your question from before, if I don't answer your question from before, I might ask you to re-ask it. So Wayne says, hey, Dan, if we are at the money and getting closer to expiration, why does our gamma increase, causing bigger rapid delta changes? Well, it's the math of the model. Like at the money options, gammas and thetas get really big as you approach expiration. On expiration day, both gamma and theta are at their highest. Think of gamma as the price you pay for the benefit of theta. Think about it that way. Or you could think of theta as getting paid for bearing the risk of gamma. They're opposites, but they're more like 2 sides of the same coin. So, like, why does gamma get bigger? Because it does. I mean, like the way I think about it is because like at the money options they have close to a 50 delta. Why? Because if you're right at the money, it's like a 50-50 chance of whether you're going to get assigned or not. If you're right at the money and there's a year until expiration, well, sure, there's a 50-50 chance, but if you get in or out of the money by a buck or, by 5% or maybe even 10%, the market can change courses. So the deltas don't change that much. But when it's like expiration day and you're right at the money, you're a penny away from expiring in the money or expiring out of the money. So the gamma explodes because your delta is not going to be 50 when the bell rings on expiration. Your delta is going to be 100 or it's going to be 50. It's like gamma to infinity, right? So, I mean, that's why it's like that. Interesting question, Wayne. I like that. Noble says, I put my put and call credit spreads at 20 delta on the short leg and do a 10 to 20 strike spread. As soon as I make 50 or 60%, I exit and place the next trade. What do I think? There's some of the elements here I like, and some I think are not as relevant. I'm going to start out with the bad news. Okay. So the way the option pricing model works is it basically ensures, what's the word? Fairness. Fairness is not really the perfect word, but it ensures like sort of an equitable scenario. It ensures that buying or selling, in this case, any one delta level is no better or worse than selling any other delta level. Meaning if I sell, if my method was to sell a 40 delta option and do a 10 to 20 strike spread and exit as soon as I make 50 or 60%, my trade's not better or worse than yours. And that's because of this slide. Yeah, if I used a 20 delta, that's an out of the money spread. I have a much higher chance of success, but my risk reward is a lot worse than a closer to the money spread, right? If I were doing a 40 delta, I'd have more losers than with the 20 delta, but I'm going to make more money on every trade and I'm going to lose less money on every trade. So I like that part. I personally look at that as maybe just a perpetuated fallacy. To me, I would so much rather use support and resistance to set my strikes than the delta, because the delta is arbitrary. Now, as far as doing a 10 or 20 strike spread, I mean, it kind of depends on what the stock is, right? If it's a $5 stock, if you're selling the 5 strike call and then buying the 25 strike call, that's just kind of weird, right? If we're talking about Google pre-split or Amazon, let's just say, then if we're talking about Amazon, then a $10 wide spread is like a pretty tight spread, right? So like it's really more in percentages, I think, but if I'm just envisioning like a $150 stock, which maybe that's what you're talking about, Doval. Okay, makes sense. Exiting as soon as you make 50 or 60%, I don't have a problem with that. I mean, what I'll do on some of my trades is I'll exit maybe half at 50% and then try and take a little bit more. I never hold it all the way until expiration. I just think that at some point the risk reward isn't there. If you have to wait a whole nother week to make a nickel, but if it reverses, you lose, $9.95, it gets a little silly then, So yeah, I think that part, taking profit of 50 or 60% is nice and conservative. That's cool. I like it. Yeah, it's good. Jay says, what are your rules for closing spreads and taking profits? So there you go. I mean, I state that my rule is I close at 65%, which is not far from what Doval was saying. But like I just said, sometimes I will, like, if it's one lot, I'll just close the whole thing at 65%. Sometimes if I want to be a little bit more conservative, I might go closer to 50%. Sometimes if it seems like a really good trade and it's working out, I might be a little bit greedier. Sometimes, I'll split it into 2 orders. I usually don't do 3. I usually don't like close some of it at 50, some of it at 60, some of it at 70. I usually split it up into 2 different exits. Corey says, when a credit put spread is in the money, both legs, and close to expiration, it's difficult to roll up and out for a credit. Is there a way to finesse it to get accepted? Yeah, well, let's talk about that. In a perfect world, Corey, you start doing that roll before both options are in the money. For me, my rule is, and it's a very, very simple rule, and some folks who have been trading this a while probably have a different way of doing this or a different version. But if the stock crosses the short strike and the short strike becomes in the money, that's where I either close the trade and take a loss, or I might even be able to take a profit depending on how much time's passed, or I do my roll. So I don't wait for both to get in the money. I do my roll as soon as the short leg's in the money. And one of the reasons why I think it's difficult is because when options are in the money, the bid-ask spreads tend to widen. And sometimes it's hard to get, get out of that trade even for parity. So yeah, which is another reason why, when possible, close it before that happens. Now, obviously, that's not always possible. Sometimes you wake up, you go downstairs, put your pod in the Keurig, come upstairs, rub the sleep out of your eyes, put on your office glasses, and you say, log in your account and say, oh my goodness, what happened here? How could the stock be, oh no, like all of a sudden this credit spread is working out so great, now both legs are in the money. You make enough trades, that's going to happen. When that happens, there's nothing you can do. So the thing about difficult to roll up and out for a credit, when you're in a situation where you have a losing trade, ideally you'd like to do an adjustment to turn that losing trade into a winning trade. But if you can't, how about if you turn that losing trade into less of a losing trade? That still works. I mean, if that's the only trade you ever make in your life, then that sucks. But if you're like a trader and you make a lot of trades throughout your trading career, right? And even if you're a retail trader, you can still call it a career and you can still call yourself a trader. If between when you start trading, make your first ever trade, to 10 years, 20 years later, when you make your last ever trade, if you make some of your losses smaller by adjusting, you did great, right? So yeah, don't feel bad about a losing trade. You know, if you make 10,000 trades, I mean, I estimate I probably made about 50,000 trades. I made a lot of trades in my days. You know, if you make 20% of that, if you make 10,000 trades, guess what? You're going to have some losers, and it's okay. It's all part of the game. So yeah, keep doing what you're doing, but don't beat yourself up if you can't just make it a winner. Can you, on credit spreads, suggested, what? Not sure what that meant. Mark says, do you have an exit strategy if the trade goes against you? Yeah, and we were just kind of talking about that. There's one of two things you can do. One, you can close it down and take a loss and move on. There is no shame in taking a loss. They say your first loss is your best loss because you take it fast and it's small and you're out and you move on to a better scenario. Whenever you have a loser, you always want to make your money back. But you know what? You don't actually have to make it back on that same trade. If the market changed and your forecast changed, like, you know, like it looked like, hey, this stock is going to stay above 50, and then some brand new news comes out, it might not warrant stock being above 50. Your thesis might have changed. Close it, take a loss, and put that money to work on a trade that is better. So yeah, so that's thing one. You can close it and you can take a loss, or you can do an adjustment. If it's a put credit spread, we would typically roll down to a lower strike. If we're very close to an expiration, we might have to also roll out to a longer term expiration. We would only do that if there's more support below the trade. The new trade has to also fit our criteria for being a good credit spread. If it's a call credit spread, we roll up to a higher strike if there's resistance. And if we're too close to expiration, we might also have to roll out to further out expiration. Good question. Where do you locate high option activity? Well, I mean, one thing, you can just look on your brokerage platform, and I keep a column for volume and another one for open interest, and it shows up there. You can also look at time and sales. I've got some fancy schmancy stuff that I'm still working on for credit spreads. Not ready to roll out just yet, but it's all sort of programmed, and I'm able to identify them, but we don't have that available to the public just at this time. How do you choose the strike and date for your cash covered puts? I typically keep them pretty short term. Not always. Sometimes I have to go a little further out in time. But basically, there's a little bit of science behind it, but basically, I think, where do I want to buy this stock? So where's my target price? What is the premium I can get? And I take the strike price minus the premium. And if I get a sign, that's where I would be buying it. Am I happy with that? And if I skate, if the stock doesn't get down and I don't get a sign, is it worth doing for that amount of premium that I'm going to collect? Usually, most of the time, like if you sell a year-long put, you usually don't, like you would usually be better off selling like 12 1-month puts than one 12-month put. So I would have to do a whole presentation on that. And I could one day. They're always asking me for topics. So maybe next time Michelle asks me, I'll suggest that. Use the $5 spread. How do we decide on the spread? So if you look, like you always have different choices with your spread. Like if all the strikes are in $1 increments, I can go $1 wide, I can go $2 wide, I can go $3 wide, I can go $4 wide, I can go $5 wide. But if you ever compare those, like next time you're thinking about doing a credit spread and the strikes are $1 wide, look at your risk reward on the $1 wide spread, on the 2, on the 3, on the 4, and on the 5. Almost every time, in fact, I bet every single time you'll get better risk reward with the $1 spread. Usually I will skip a strike sometimes, but 9 times out of 10, not skipping a strike ends up being a superior trade. But check it out. Like it is situational, so look into it. Like I said, I don't always do. Sometimes I will skip a strike, but usually it's a better trade if you don't. What factors should one consider when determining the time frame to put on a credit spread? So look, if you are going to throw a baseball at a target, all right, whatever your skill level is in throwing a baseball, I think I probably don't have a lot of skill, and that target is 10 feet away, probably going to get it within this amount of a range, right? You're going to get it pretty close to that bullseye. Now, if the target is 30 feet away, are you still going to be within that same range? No, like it's going to fan out. You're going to have much more margin for error 30 feet away than you would 10 feet away. Well, guessing where a stock is going to be in the future is the same way. So the shorter the amount of time to expiration, the more likely you are to predict it, right? More likely you are to be right. If your bet, if you will, it's not really a bet, it's something different than betting, trading is, right? But let's just put it crudely like that. If your bet is that the stock is not going to fall below 60, if that bet lasts 1 day or 1 year, which are you more likely to be right on? 1 day. Less can happen in 1 day. So I like to keep them as short as I can. And typically I make more in time decay selling shorter term options. So, we'll probably have a whole presentation on just that as well, but shorter is better. All right, I think I can take maybe 2 more questions here, maybe. You guys are asking some great questions. Do you always trade at the money or out of the money or mix it up? What's the criteria used to identify? I tend to do more out of the money than at the money. I do find that at the money is interesting because so many people do it, but I've developed more skills for out of the money spreads, I think. I just feel a little bit more comfortable with them. Let's see here. When's the best time to exit a credit spread if the underlying stock moves quickly in your favor? I do like to set it at a certain percentage. If I put the trade on right now and it just really moves in my favor unexpectedly. If I can buy it back for 65% of what I sold it, I'll do it right now. I look at it more that way, not how much time has to happen, how far the stock has to move, what percentage I can buy it back. Meaning if I sell it at $1, if I can take, the most I can make is $1. So 65% of that is if I can buy it back at 35 cents, I'm going to do that. I don't care if it's an hour later or 3 weeks later. If your credit spread goes against, then we have a 3-to-1 loss. If you sell a put, you get more credit. And if it goes against, we get put to us, then we sell a call. Yeah. Myron Scholes proved that you can't, that game only goes so far. At some points, you just have such a string of bad luck that you run out of money. Is what happened to Long-Term Capital, a company he started. But yeah. I mean, Bernard, there's something to that for sure. I like that a lot. I like it. Yep. There's lots of different adjustments you can do. Will says, nope, I already said that. No, I do not, Justin, I do not target specific deltas. That's mathematically speaking, no one delta is better than another to sell. That's just like how the option pricing model works. Durrell's question is, you open your short strike at the money with the 35 to 45 days to expiration. Within 5 to 10 days, you go in the money. Do you give it time or get out? As soon as it crosses the short strike, I get out. Hey, Dan 2.0 here. I like that. Thank you for doing this. I'm relatively new to trading with a fast learner. Well, there's a little bit of a long question. It's about iron condors, but I'm just going to make this easy for you. Think about an iron condor as 2 credit spreads, as a call credit spread and a put credit spread. And what I'll do is, once I can take a profit on one of the credit spreads, I'll do that a lot of the times. In fact, I'll always close it. Well, not always. Most of the time I'll close it before expiration. So just like, think about your iron condors as 2 different spreads, and you're in good shape. And please get a reply. I got interrupted. A reply about what? Kevin? I cannot. I don't know what to reply. Okay, I'm going to take one more question and then we got to go. Oh, John asks a great question. Do you use IV percentile as a factor? Yes. So I'm glad you asked that, because I get to drop one more like little nugget on you. Oh, and I'm looking, there was a few people who left class and they are not going to get this. You guys put in the effort, you put in the time, you invested in yourselves by sticking around here the whole time. And I love that. And the folks who left early don't get to hear this. So, okay. Do I use IV percentile as a factor? Yes, because here's what we're doing with this credit spread position. It's true that if the spread goes in the money, like if the stock moves against me, I can lose money, right? And if it moves the other direction, I can make money. It's also true that if time passes, I can make money, and I will. But there's also this volatility factor. And the more I sell the spread for, the better, right? And in fact, when we're talking about different deltas, like if we look at a stock that's like well, let's, instead of using delta, let's use a certain percentage out of the money. Okay, similar concept, different but similar. If I'm looking to sell a spread 3% out of the money, right? So the stock is at 100. I'm going to sell the 103 call and buy the 104 call. Okay. If I can sell that call for 35 cents, the most I can make is 35 cents. The most I can lose is 65 cents. Okay, fair enough, right? But what if those options were more expensive? What if I could sell the spread for 45 cents? Then the most I could make is 45 cents. I could make 10 cents more. And the most I could lose is 55 cents. I could lose 10 cents less. What we're talking about here is implied volatility. Implied volatility, like I'm going to tell you the secret about implied volatility. What it really is how cheap or expensive options are. You think about it that way, you're going to be miles ahead of most traders. It's how cheap or expensive options are. So I really only want to put on credit spreads when I can sell them when they're overpriced, when I can get a bigger premium, all else held constant. So like, it's not just about direction, it's not just about time, but it's also like, whenever I sell anything, I want to sell it when it's worth, when I'm selling it for more than it's worth, right? Whenever I buy anything, I want to buy it for less than it's worth, right? So yes, use IV percentile, absolutely. As long as I'm making sure that like earnings isn't coming out or something, like if that's why implied volatility is high, I'm going to stay away. But yeah, great question, John. I love that. Okay, that, folks, is all we have for today. Thank you so much for spending your afternoon with me. And I hope that this was super helpful. And I am going to be back, let's see, I believe it's next week with another really, really great, really fun presentation. You're going to love it. And I'm going to see you then. So mark your calendar. I believe it's February 16th. I'll be back. All right. Trade well. Thank you. Catch you next time. Bye, folks. Once again, I'm Dan Passarelli. Trade smart.